Hi guys, and welcome to this month's webinar. So this is all about how to invest with inflation. Now, not only how to invest with inflation, but should I invest with inflation as well? Now, importantly as well, one thing that I'd say is we thank everyone every month for turning up month in, month out on these webinars, but also for you guys who are watching now on YouTube or any subsequent video hosting platform that you're watching this on. But if you could hit the subscribe button, hit the like button, it's much appreciated, and it will give you regular updates on exactly what's coming in our end. So hit that like button, hit that subscribe button, and without further ado, let's get on with the webinar. So first of all, one thing that we always know is the objections that we have here. That's the key to any kind of business, especially like an advisory business like ourselves. And typically over the years, the majority of objections that we get are the tried and tested objections that's going on in the news today. So for example, things like COVID. We've also had things like Brexit. And of course now it's like, they're concerned about investing due to inflation or economic downturn or increase in interest rates. But the reality is it's sometimes times like this that actually gives the most opportunity. And over the years, one thing that I've seen of doing this, and when I first graduated from university, I actually went into a brokerage with stocks and shares. And the reality is that the best times to invest were the downturns. So look, we're going to sort of like head in and look at some of the previous downturns and actually ask ourselves, would it have been a great time to invest in the property market? And would it have been a great time to invest in the stock market? So look, let's have a look. Well, first of all, when we look at things that have taken place in the past, we have seen numerous different things in the stock market. We've seen mini dips and we've seen major crashes. We actually see more mini dips and major crashes in the stock market than we do with the property market. The property market is a little bit more stable. However, the reality is that you don't see the upward turn in the property market than you do the stock market. For example, you could invest 100 grand in the stock market and a week later it's up 30%. You can't do that in property. Property has a little bit more stability than that. But that also has an adverse effect in the stock market, that you could invest 100 grand and you could lose 30% within a week. Again, you can't do that in the property market. So look, let's have a look at the stock market and when there was opportunities previously to invest. Well, then there was the Gulf War. So now there's two Gulf Wars that the majority of people remember. There was the 90s and 2003. The one that I'm reflecting on here is the 2003 Gulf War crisis, where the stock market went down to roughly 3,300 points from memory. And the reality is the majority of people that I spoke to at the time in the job that I did were getting out the stock market, hence why it was falling. But the majority of the people that I spoke to were amateur investors, so to speak. People who were putting in whatever they were doing, 5, 10, 15, 20,000 pounds. The big guys who were going in and putting several millions of pounds, they were buying. They were buying because they weren't looking to make a quick buck. They weren't looking to make something over a period of 1, 2, 3 months. For them, it was all about the long term. And they thought, you know what? The Gulf War for them was a buying opportunity. Very rarely will you get a stock on the stock market or a property that's directly affected by what's going on outside. So whether it's COVID, whether it's the Gulf War, whether it's Brexit, typically these things are short-lived. And the reality is that the markets, whether it be the stock market or the property market, bounces back considerably after that. So we've also had the financial crisis of 2008, 2009. Now, everyone knows the answer to this, but you have to look and say, would it have been a great time to buy stocks and shares at that point? Would it have been a great time to buy property at that point? 100% it would have done. If you bought a property back in 2008, 2009, pretty much anywhere in the country, you'd have probably doubled your money quite comfortably. It's probably similar with stocks and shares. If you'd have invested back in 2008, 2009, you'd probably doubled your money again, maybe even more. So the reality is that when everyone else is losing their head and getting out of the market, whether it be the stocks or property, the big investors and the intelligent investors, they're getting in because they're in it for the long term. They're not looking to make that quick buck. They're not even worried if they invest and it dips another 10% because they know that the longevity in whatever market they're investing is there. And again, we go to COVID. Again, COVID was a perfect time when March 2020, the stock market fell just below that 5,000 barrier, and we're now over the £7,000 mark. So it's a great opportunity to buy. Bank of England was writing reports saying that the property market was going to fall 30%. It did quite the opposite. It went up over 15% over the period after COVID into now. So the reality is all of these times have created opportunities for buyers. But the majority of buyers, they sit on their hands. And we're going to come later in the webinar to see what happens if you do sit on your hands. And we're going to compare it side by side. And again, the financial crash of 89 to 93, this was a real bad time for the property market. Properties were being literally handed back, keys were being handed back to banks. Property fell up to 20%, but we're nowhere near that because the majority of the interest rates at those particular times for banks which they weren't controlled by the Bank of England, by the way, at that time. They were controlled by the government, which at the time was a Tory government. The interest rates were 15%, and mortgages were sky high. So it's no surprise that people were handing back their keys. But let's have a look. Now, let's go into the fact and run something side by side. Well, but the first question we're going to ask ourselves is, do you actually need to invest when inflation is rife? The reality is, what are you going to do? If you don't invest, what are you going to do with that money? The chances are nothing. You're going to leave it, you can let it sit, and the money's going to procrastinate in a bank, and it's going to be eaten away at, because inflation is going to eat away at that money. If you want the same lifestyle last year to this year to next year, you're going to have to spend more money to get exactly the same lifestyle. So just to stand still and not progress, you're going to have to spend more money. So the majority of people will start to eat into their savings if they're not making money, or if they've not invested it. So do you need to invest? Well, in my opinion, yes, you do. When inflation is rife, you've got to invest. You've got to try and get as close to that inflation, if not beat it, if you possibly can do. So for me, it's a given that you do have to invest. Now, if you see inflation in the property market, just people that waited before COVID and moved after COVID, especially if they were upsizing, the reality is that they had a £600,000 home they could have bought. They suddenly see 9% increase in the property market, and they're now paying $654,000 for the same property. And their property may not have gone up as much, because if you're upsizing and there's a big difference and there's a big gulf between the price of your property and what you're upsizing to, or if you're looking for a buy-to-let and again you've seen 9%, 10% increase in the price of the property, you're paying 10% more than you would have done when you first actually looked at that particular property or that investment. So we then start to run things side by side. Now, this on the right-hand side, and I'm going to run on the left in a second, but this on the right-hand side is if you purchased a property after 2 years. So this is you sitting on a £50,000 deposit. You're going to let that deposit run down, and we're going to assume that you're going to be eating into that due to inflation, and we've dropped it by 10% a year. So your deposit now, you see, is $40,500. Whereas actually, at the present time, you've got an opportunity to invest with your £50,000 deposit. So let's run these side by side. Let's take in the green here. So we've got a £50,000 deposit. We can buy a price of the property at $200,000, as you can see. So we've got £200,000 property that we can buy. Our deposit of $50,000 is comfortable. It's 25% down, and the rest of it, the other 75% of it, we remortgage. So we remortgage $150,000 of it, and at a mortgage rate of 3.5%. So we've got 3.5% currently on buy-to-lets. Some people overseas will be paying slightly more, but we're going to go on average here at 3.5%. So 3.5% on 150,000, we've got £5,250. That's our outgoings for our mortgage. Now we're going to keep it really simple. There might be other outgoings. For example, there might be other things like maintenance fees or management, but we're going to keep it straightforward and say the mortgage is your only outgoing. But of course, we're also going to keep it simple on the income. So the income, we've just done a traditional flat rate of 6%, and we've done 6% on the left-hand side if you bought now, and 6% on the right-hand side if you bought now as well. So if you bought on the left-hand side, 6%, but again, you could get higher income. You could do short-term lets, for example, which is dramatically higher than a traditional let, but we're going to base it on a traditional let. So if you've got an income of 6% coming in, minus your mortgage on a £200,000 property, you've got £6,750 coming in year on year. Now we're going to say that you're going to buy now, and we're going to run this for 5 years, and we're going to see what financial year position you're in now to what financial position you're in 2027. So just a straight 5 years. Now, if you've got £6,750 coming in, year out for 5 years, that's a total income of £33,750. Now, in terms of your growth, this is key. We're going to say on both sides, we're going to say that you've got 5% growth per year. So you've got year 1, 2, 3, right the way down to 5 years worth of growth of 5% on every single year. So it goes up to 210, 5% of the 210 takes you to 220 and 231 and so on. So we've got a total growth of 55,256, which gives you a grand total of £89,006.31. So if you invested now and we had 5% of growth every single year for 5 years, 6% income minus your mortgage, that is your total overall. Of course, you still own the £200,000 property, but this is your total overall income and growth. And of course, that's based on an interest-only mortgage. We now come to the right-hand side. Now, what we've done here is we have clients here all the time who turn around and they say, do you know what, I'm going to wait 2 years and then I'm going to buy it because I think the property market's going to dip. No problem. Everyone has their own opinion on it. We don't think that's going to happen, but the reality is that's what people are thinking at the moment. They think it's going to dip by 10%, 15%, whatever it may be. But let's say it does dip by 10%, and we'll come on to our reasons why we don't think that's going to happen in a minute. But if it dips by 10%, then this property price here on the left of 200,000 is now 180. Great, you got your price £20,000 cheaper. However, the downside is that if we've got inflation running high at 10% per year, as I said before, to stand still and do the same things you did last year as this year as next year, you're going to be eating into your savings. So you've now got savings of £40,500. That £50,000 is being eaten into. So although the property price is decreased, so ironically has your deposit. So you've now got less deposit than you had back 2 years ago. So what we now have to look at is what you can afford with that. Now, the property price of 180,000, you can't afford that anymore because you need £45,000 to be able to afford that property. You've only got 40,500. So actually you can now afford a £162,000 property. So what you could have afforded 2 years ago, which is this property on the left, you can't afford anymore. So you've got to downsize a little bit. However, you can afford a £162,000 property with your current deposit, which has been eroded. And the reality is that your mortgage is going to increase. Now that might sound bizarre, the fact that you're paying less in terms of you're paying on a lower overall amount, but we were saying that the interest rates are rising. We can see interest rates are rising, we know they are. So if you're getting a buy-to-let mortgage now at 3.5%, chances are in 2 years you might be paying 5%. So now not only have you got a lesser quality of property, you've got a smaller property, but you're also paying more for your mortgage. So you've now got a mortgage rate of 5%. And you might notice here we've only done 3 years, well, because that's because we're going to end this in 2027. If you've waited 2 years, then you've only got 3 more years of growth and 3 more years of income. So this income is now lower because it's 6% on a lower price property of 162,000. Your mortgage rate is increased, so the difference is quite dramatic. So whereas you're making on the left £6,750 after your mortgage, you're now making £3,645. Again, but you're only doing that over 3 years. So your total income now, rather than being 33,000, you're now 10,000. So the reality is there's a big difference between what you could have got income-wise and just by sitting on your hands. In terms of the growth, that's dramatic as well. Now we're going to say that it's still going to go up 5% a year. You've got £25,000 worth of growth here because you've only got 3 years of it. And on the left-hand side, you've got £55,000 worth of growth. So in terms of the difference, you can see here £52,536 and 6p difference between making an investment now and making an investment in 2 years' time. Now, I know there are going to be other variables. We had to keep as much of the same as possible to make sure we're comparing apple with apple, so to speak. But the reality is pretty much like that if you run it. Now, you might get lucky. You might have the money ready now, the property market crashes by 10-15% next week, and then you buy in 2 weeks' time at a lot cheaper rate. But we all know things don't happen like that. The property market doesn't crash overnight, it ekes its way down. It doesn't just plummet like the stock market can. So the reality is just by doing this, it is far better to buy now. If the property market fell by 20 or 30%, totally different story. You'd see the left-hand side being red and the right-hand side being green. You'd wait for 30% dips all day long. But the reason why we don't think it's going to do that is because one, it's never done it before. That's the first thing. We've never seen a 30% dip in the property market. As I said, even the late 80s and 90s, that was 20%, and that was a bad dip. We don't expect to see 30%. Secondly, the reality is that the interest rates, we just don't expect to go to the kind of levels that people are thinking. People are saying, oh, will it get 10%? I don't think it's going to go anywhere near that. People have had to, or the Bank of England have had to do quantitative easing for a number of years. It's going to be dangerous for them to start to raise interest rates to a certain level where it's going to become unaffordable for people to pay back mortgages and loans. And don't forget, the property market is a great tax income for the government because stamp duty, if the property market runs hot and there's a lot of stamp duty receipts, it means more money for tax for the government. So they want the property market to do extremely well. So they don't want to dramatically impact it too much. So we don't think there's going to be any kind of impact from, or major impact, I should say, from inflation and increased interest rates. Even if we saw 2.5 by the end of the year, maybe hitting up to 3, the reality is that the Bank of England have told every lender they have to do stress tests of 3% above what their rate is over the last decade. So we're only at 1%, which we were a few years back in terms of interest rates. We're not far off where we were pre-COVID. So the reality is that they know that we can pretty much get to 3.75% on a base rate from the Bank of England, and we'll still be good. We'll still have a property market that's performing. It starts to increase up to 4-5%. We know there's going to be a few issues there, but they've done stress tests to take this mortgage rate right up to 3.75%, I should say. So should you be investing? Doesn't matter. This is not a big webinar about yes, phone us, put it in property. It's not about that. It's about saying, should you invest with inflation? Of course, you've got to try and beat it. Is your money best left in the bank with inflation? Of course not. We've demonstrated here. The reality is that your money's going to be eroded if you want to just stand still and have the same things and the same goods, luxuries, holidays, whatever it may be that you had last year and next year. So inflation's all about making the right investment at the right time and trying to just get as close to that inflation in terms of your income and your growth as you can. But all in all, guys, as I say, we've got great opportunities here. We've got great options. And anything that you need, just don't hesitate to call. What we'll basically do is we're going to leave this up so you've got an exact email address at the bottom to contact us in. That's our phone number there, guys, and there's no high pressure tactics here. We know that there are some companies out there where they'll ram a property down your throat. It's not how we work. We'll try and find something that suits you. If we've got it, great. If we don't, we don't. But look, have a lovely rest of the week and a good bank holiday weekend. I look forward to speaking to you soon. Take care.